I think that the gold-silver ratio has psychological value. That is, it has value in the near term because people think it has value. I'm not sure what the ratio has anything to do, that the ratio has anything to do with the relative utility or hence the relative price of either commodity. What the gold-silver ratio would be useful is in a speculative situation where the silver price tripled. If the gold-silver ratio were to fall from 100 to, say, 35, the pundits for silver could say it's still undervalued. It could still go to 16 to 1, which is the ratio suggested by their relative abundance in the Earth's surface. In other words, it's a factoid, useful for traders, irrelevant otherwise.
In today's news recap, gold storms back as Chinese demand roars in. The dragon's bid is back. Gold's bounce back to $3,300 isn't just another dead cat rally. It's a statement, and once again, China's in the driver's seat. After flirting with the psychological floor just above $3,100 last week, gold has roared back to where it closed April. But this time, it's not Western hedgers or ETF flows leading the charge. It's a familiar heavyweight, Chinese onshore demand. According to Goldman's flow tracker, Shanghai's night session has come alive, triggering a classic COMEX sympathy bid. Open interest on SHFE is back at all-time highs, with gold and silver both seeing a sharp jump, plus 3% and plus 4% respectively. That kind of synchronized positioning doesn't happen by accident. More telling is the resilience of domestic Chinese traders. Despite the 8% drawdown from the recent peak, they held their fire, refusing to dump positions. That's not momentum chasing, that's conviction. And when the SGE/LBMA-RB lit up, global buying interest reignited. Chinese physical imports, ex-PBOC, also just clocked in at a one-year high for April. That's impressive given gold's elevated nominal levels. It means the physical premium on the Shanghai Gold Exchange, SGE, isn't just holding up, it's punching through resistance. And the market setup is clean, ex-China hedge fund positioning is light, and CFTC data shows specs are flat, not leaning long. That makes the skew look dirt cheap. 6-month 25 delta risk reversals are trading around 2.25V with 6-month implied vols near 19.5%. I think you want to own that optionality. Vol should outperform if we break new highs, and the Vanna tailwind is real. Bottom line, this isn't just a bounce. This is a reset. The physical bid from China, the clean slate in Western positioning, and the quietly persistent vol buyers all suggest one thing. The gold bull isn't dead. It was just consolidating. And the dragon just hit the buy button again. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps, and check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
For different reasons than the questioners. I stack metals because of fear, and the best store of value over time has been gold. In other words, I'm looking to maintain my purchasing power. My experience has been that precious metals bull markets are led by gold. And when gold establishes momentum, and when that momentum validates the narrative in the mind of generalist investors, and generalist investors come into the precious metal space, perhaps because of its relatively lower unit cost, market leadership changes from gold to silver. As a consequence, I consider silver to be a speculative asset and gold to be an insurance asset. This sounds really conceited, I'm old and fat and rich. I don't need to get rich on silver. I need to maintain my purchasing power. So most of my physical precious metals are stored in gold, the investment portion of my physical precious metals. The speculative part of my precious metals are stored in silver because I've lived through 3 prior silver bull markets, and they're an awful lot of fun when they happen. The government doesn't particularly care about the rule of law in a bad situation. If the coins that you're storing have melt value in excess of their stated value, then, except for the problem of liquidity, which is to say you have to transfer them for something that you want, which is an extremely inefficient process, it is important that you maintain liquidity in U.S. dollars too. I know this sounds odd because there is a risk, I think, a risk in the very long term of a currency reset. The problem is that we have to live right now. I maintain substantial U.S. dollar liquidity, even though I know that having those dollars invested in very, very short-term obligations, certificates of deposits from solvent banks, short-term U.S. treasuries, although I know that I'm getting paid 4.3 or 4.4% interest in a currency where the purchasing power is deteriorating by 7.5 or 8, I know too that I have to maintain liquidity. I've lived through several episodes of illiquidity, including that famous panic of 2008. And having the cash gives one both the tools and the courage to take advantage of that circumstance rather than being taken advantage of by that circumstance. So by all means, save in gold. By all means, if you are concerned enough, save in silver coinage without any sense that the government will back that coinage because of their, quote, promise. But also maintain liquidity in the currency that your life is denominated in, which is to say the U.S. dollar, in very short-term obligations. Don't go out past 3 years on the yield curve.
In today's news recap, silver eyes $33.23 breakout as triangle pattern signals a volatile move. Silver is trading sideways at $32.35 in a tightening symmetrical triangle that has everyone waiting for a breakout. Gold had its worst week since November as risk appetite surged following a temporary U.S.-China trade truce. The U.S. dollar index fell 0.3% on Monday, making dollar-denominated precious metals more attractive to international buyers. Sentiment changed after Moody's downgraded the U.S. sovereign credit rating by 1 notch, citing rising debt risks. That downgrade, combined with a return to risk-off trading, has added some shine back to gold, said Tim Waterer, chief market analyst at KCM Trade. But the real wild card is Donald Trump's tariff threats. Treasury Secretary Scott Bessent confirmed the administration will impose duties on countries that don't engage in good faith trade negotiations. That has rekindled fears of another round of global uncertainty and a potential tailwind for safe haven assets like gold and silver. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, turn on notifications, and check our new Numismatics Handbook. Most stackers want to get active, but swapping their metals for dollars isn't an option. There's plenty of opportunities in the overlooked numismatics world. Mastering U.S. coins, key dates, and errors pays off by multiplying your ounces and capitalizing where others aren't paying attention.
The U.S. dollar, I think, will do relatively well compared to many other fiat currencies. I believe that savers probably need to build a diversified base of short-term currency savings accounts, more than one. I am heartened by the fact that there's still a lot of liquidity in the system. And if that liquidity decided to come into any particular segment of the market, that segment would do well. There are literally trillions of dollars sloshing around looking for a home. In answer to the question, which is to say, if people become afraid of the stability of the U.S. economy, the first thing I have to say is, where will they go? Perhaps they just go on strike and save. I remember very well the period 1968 to 1982, the last period of serious debasement of U.S. purchasing power. And with the exception of gold and resources, not very much did well. We had a 14-year period where equity markets were stagnant and bond markets got clobbered. Is that going to happen again? I don't know. I, on the one hand, am afraid of the fact that we are going into a period of increasing volatility with much higher government debt. That part scares me. At the same time, we are going into it with an immeasurably stronger private economy. The increases in productivity that we have achieved from technology is spectacular. We can do more with less capital. I suspect that these two countervailing features, the incredible strength of our private economy and the incredible stupidity around our public economy, will interact with each other the way two great big weather systems interact with each other, that will have an awful lot of volatility, an awful lot of sound and fury. I wish I could tell the questioner how it's going to end up. I don't. For myself, I try to buy the equity of very high quality companies that I understand. I don't buy the market. I buy individual companies. I do a lot of savings in gold, a financial asset that isn't simultaneously somebody else's liability. I also maintain liquidity in several currencies, currencies from countries that I invest in or like to visit. And I invest in two sectors that I know extremely well personally: conventional financial services and natural resources. Whether or not this is an optimal strategy, I don't know. It's the only one that I personally am comfortable with, and it's the only one that personally goes to my strengths.
What do you think about Rick Rule's take? Is he spot on or sounding the alarm too early? Whether you're a seasoned stacker or just waking up to the risks of fiat and central bank manipulation, Rule's perspective hits hard with historical context, monetary realism, and a no-nonsense approach to protecting wealth. Drop your thoughts in the comments. Are you adjusting your strategy based on the gold-silver ratio, or do you think the Fed still has a few tricks left and that both metals will go down? Now, watch this video right here because it's a perfect fit for you, and I'll see you on the other side.